Hello, 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 hello. Welcome to our next chapter, that is your taxation in case of ESOP. ESOP is your employee stock options. So many a times companies, apart from remuneration, apart from the salary, they also give employees stocks of their own companies. This is also called as sweat equity. So it is taxable in the year when shares have been allotted to the employee. It will be taxable in that year itself. Now, how will you calculate what amount is taxable? That is fair market value of share. Now, this ESOP, say for example, if it is being traded, for example, say for example, Reliance share price. Reliance share price is approximately 2400. Under ESOP, employees sometimes would be given for free, sometimes they would be asked to make a very small payment. So employees may be asked that, boss, you make only a payment of 1000 rupees, rest 1400 is discount for you. So therefore an employee is getting a discount of 1400 rupees because 1000 rupees he has paid. So basically this amount is taxable because this is the perquisite that you are providing. So fair market value shares, that is 2400 minus amount paid by employee, that is 1000. So 1400 will be your taxable value. So if your share is listed, now how do you calculate? How do you calculate the fair market value? So if your share is listed, it will be the opening price at which it was listed plus closing divided by 2. So opening plus closing divided by 2, that will be considered as your FMV, that is to determine this 2400. If your shares are not listed, your FMV will be determined by a merchant banker. Capital gain will arise when such shares are sold. So this 1400 has already been taxed. Capital gain will arise when such shares are sold. Your capital gain will be sale value minus your fair market value because you have already paid 1000 rupees. You have already paid tax on 1400. That means this 2400 is your actual cost for you. So sales value minus your fair market value, that will be your capital gain. And any startup to deduct TDS within 14 days. If a startup is offering ESOPs, they have to deduct TDS within 14 days from earlier of 3 days. Expiry of 48 months from the end of the relevant assessment year. Okay, remember it is 48 months. Then next, from the date of sale of ESOP by employee, if the employee has already sold the ESOP, that is your employee stock option, from that date. And third, from date when SSE is not an employee anymore. That means before the employee leaves your organization, or 48 months from end of relevant assessment year, or from the date when the employee has already sold, whichever is earlier, TDS shall be deducted within 14 days. Within 14 days from these three dates. Okay, and with this we are done with the chapter. Solve questions. Very few questions would be there, and I will see you in the next chapter, that is your return filing and assessment procedure.